Hi, I'm Brooke Thackeray. Welcome to What's Hot and What's Not in the month of December for the stock markets. Let's start by taking a look at the current price action for the S&P 500. If we take a look at the S&P 500 from late 2020 into the summer of 2021, we saw the S&P 500 put in a pretty solid performance, and then we saw the S&P 500 correct down here in September and then rally back again in October, and then we've recently seen a pull back down here again. So we formed a pattern of higher bottoms at this lower level here. So what we really need to see is we need to see the S&P 500 break solidly up above 4,700. Right now we're sitting at the 50-day moving average. We're sitting on the boundary at that lower level. So as the market tries to find its footing, and we're seeing volatility increase. So over the next few days, we should get some indication of whether the stock market is actually going to find its footing further and start to go up, or if it's going to continue to struggle into month end here. If we take a look at what's going on in the sectors of the market here, here's the S&P 500 in November. For the month of November, the S&P 500 was slightly down. Consumer discretionary was positive. Recently, though, that sector has been showing some weakness. In the first week of December, it was negative. Consumer communication services was largely negative again, and the technology sector was positive. If you take a look at all the other sectors of the market here, so here we have the defensive sectors and the cyclical sectors, all of these going all the way across were negative. There was only two sectors of the market positive in the month of November, and the technology really helped to support the S&P 500 from bigger losses overall. So, but a quick warning on the technology sector, and that is that, and I talk about this in my 2022 Thackeray's Investors Guide that's just coming out, and that there's a period in December, the early December, where the technology sector tends to pull back. So although the technology sector has done well, something to watch out for is if we might see that seasonal pullback in the technology sector now. It tends to once again find its footing later in December and then go into January, but just something to watch out for overall. If we take a look at what's happening for the yields in the marketplace, for the month of November, we saw the yield actually increase early as there's a lot of talk about the reflationary trade. But then we've seen, as we talked about tapering, investors really focus on the whole tapering aspect because the economy might be slowing down and what the tapering might do to the economy as well. We've seen the yield actually on the 10-year Treasury note decrease. And as of the first week in December, it closed at 1.35%. If we take a look at, before we get into the charts for December, I just want to bring out that my new book, my 2022 Investors Guide, is just being released. It could be in bookstores now, or it's scheduled for early December to be in bookstores, something to watch out for. I've added some new trades here, Microsoft, Verizon, Corning, Valero, Adobe, ADP, and more as well. So something to take a look at, perhaps for Christmas presents. Now, I will say that I'm a victim of the supply chain fiasco. Printing got held up substantially, and that was because a lot of printers, a lot of publishers that print their books over in China because they don't have real tight timelines, moved their printing back to North America, where the timelines just totally blew out and became unacceptable, where they had a 4 to 6 month wait for printing, and so just jammed up the system overall. So the book's a little bit late this year, and I apologize for that, but some good stuff in the book overall. And if we take a look at the month of December, so these charts now, a lot of them are from my 2022 Investors Guide. This is the average year for December from 1950 to 2020. You tend to find that you have a little bit of a bump at the beginning of December and then a pullback and then a rally here. And at some point, sometime, whether it's halfway through or 3/4 way through the month of December, you tend to see a rally taking place in the market. Doesn't mean it's going to happen, but that tends to be the seasonal pattern for the market. And if you take a look here, this graph down here over the same time period shows you the daily probability of any trading day, individual trading day increasing. And you can see that these bars are actually quite high at this time, around the Santa Claus rally time that the media likes to talk about. So we tend to see some positive action. Now, I will say December's also been a month of inflection where sometimes if we've seen a really highly valued market and the stock market going up, sometimes you'll see a pullback in December take place, or vice versa as well. So we have to watch out to see if that inflection does happen. If we do see a correction early in the month, it could present a good opportunity towards the end of the month, late in the month as well, for the market and into the new year as well. If we take a look at what's happening at the sector level, and this is from 1990 to 2020, these are the major sectors of the market, and they're ranked according to their average gain for the month in this time period. This last column is the frequency of outperformance relative to the S&P 500, how often the sector outperforms the S&P 500. Interesting that the utility sector here is at the top, and you've got financials here as well. But I do want to point out one thing. The one thing that's really critical, it's not just about average gains, it's also about frequencies that are very important. Take a look here. We're talking about these top sectors here are all like in their 50s. We don't see that really strong, dominant frequency of outperformance pattern taking place. So this shows you there's a lot of sector rotation that goes on in the market in December. So you have to be careful and on your toes. And we're down in the 40s and even back in the 50s here. Gold, I should say, in information technology here is at 39% outperformance frequency over the S&P 500, and also on an average basis tends to be weak as well. Now, this tends to take place in that first half of the month for technology. So a few days into December, you tend to see this pullback take place in technology, setting up for the sector to perform well later in the month and into January as well. But overall, for the whole month, technology tends to be a little bit weaker. If we take a look at what's happening at the subsector level, here's the home builders. Home builders, you can see here, well, it's got 74% frequency of outperforming the S&P 500 from 1990. These subsectors are all just selected. They're not a complete index. So these are just showing you some examples here. Home builders has been on fire so far since the end of October. It's done extremely well. As interest rates have pulled down, that's benefited the sector. But investors are still really interested in the home builder sector, so it's helping to support that sector on a go-forward basis. So this is at the top of the sector. Steel tends to perform well. Biotech can perform well, either really well or poorly, so you have to be careful for that sector. Last half of December tends to be strong for the biotech sector. If we're just going to jump down here, here's silver. I'm going to talk a little bit about silver, and gold is right here at the bottom. Down in the 30s, we're looking at transportation. Transportation's already starting to underperform the S&P 500. Here's autos. We're seeing the same thing. Retail tends to underperform in December. Tends to outperform in November and underperform in December as well. And we're seeing signs of that right now as well. If we take a look at what's happening for gold. So I want to talk today about gold, silver, and also the Santa Claus rally as far as the trades go, and some of the seasonal trends around that. So here's gold, and then gold has actually performed very poorly this year. We're coming up to a strong seasonal period, so I thought I'd include this in the presentation overall. But there's two periods of the year. This is from 1984 to 2020, where gold tends to do well, and that's from basically July into October. You tend to find gold performing well, and that's based upon demand increasing in the fourth quarter of the year for gold itself, whether it's for the Diwali, for the Indian Diwali season, or even the Western civilization, Western world countries, increasing their consumption at that time of the year as well. And so you tend to find this rally that takes place in gold, and also too, interest rates tend to be head lower at this time of year, helping to support the gold trade at that time. There's another time period where gold starts to do well towards the end of the year and into the beginning of the year. Now, I want to point out here that here we see a peak in February, but I've got the seasonal period, strong seasonal period for gold from late December to late January. I'll show you the dates in a second, but it can run further depending on the circumstances, because it's not just about averages, and this is an average graph of the average years from 1940 to 2020. It's also about frequencies as well of success. So yes, we can see it run stronger, and that's something to be aware of, but the real sweet spot to that period really is from the end of December into the end of January itself. If we take a look at, in this case, the gold trade, so here's the July to October time period, and here's December 27th until January 26th. Now, I want to point out about this trade, these shaded boxes are the their positive performance for gold in this time period here. And if you take a look at the beginning, from 1984, the beginning years, there's not that many shaded boxes. In fact, there's a period here where it's actually fairly blank. But look at the last couple decades, we've seen solid performance from gold, positive performance from gold. So why is that? The Chinese people at the retail level were really not allowed to buy gold. It was illegal for them to buy gold back in, a few decades ago. And it's only recently that they've been allowed to buy gold. And now, at the retail level, the Chinese consumers have actually been larger purchases of gold than the Indian consumers on different years, back and forth. So very close as far as individual consumption goes. When do the Chinese buy the gold mostly? It's around Chinese New Year. So the price of gold tends to rally coming into the Chinese New Year, and we've seen that more frequently along the way here. Now, if we take a look at, in this case here, I want to show you this chart for gold. Here's gold on the top, gold versus the S&P 500. This is the yield on the 10-year Treasury note, and here's the US dollar down here. Now, before I get into that, I want to say that I've talked about this in my newsletter, that gold tends to put in a bottom. Yes, on a seasonal basis towards the end of December, but in recent years, in fact, one of the graphs I showed in my newsletter, I show that, the last 8 years, that gold's actually increased, started to rally either from late September, sometimes in October, sometimes in November, and also in late December as well. So we tend to find that some sort of correction that takes place, and then gold tends to perform well on a seasonal basis from that level. So something to watch out for. But here's gold on the top panel here. What we can see is we saw this peak back in August 2020. We've seen a decrease and really flat performance really back since March. Sure, there's been some ups and downs here along the way here, but overall it's been fairly flat. But for the year it has been negative as well. But if we take relative to the S&P 500, it's actually been underperforming. But let's take a look at the yield on the 10-year Treasury note. So the interest rates are a factor in the price of gold, as is the US dollar. So here's the interest rates and here's the US dollar. And this is on the 10-year yield here. You can see that when the interest rates are increasing, that actually had an impact, and gold started to underperform here. And in this case, yes, the US dollar was going down, but in this scenario here, the increasing yield on the 10-year Treasury note had more of an impact on the price of gold. In fact, when it started to increase rapidly and the US dollar actually increased, that was actually quite negative for gold here. And if you can see here that along the way, we've seen the yield pull back on the 10-year Treasury note and the US dollar actually increase. So they sort of outweighed each other a little bit here. But as this smaller dip was taking place, US dollar going down, and also to the yield on the 10-year Treasury going down, we did see this actually take place here, where gold was actually positive, and then we've seen this pretty flatline performance. What's impressive about this, relatively speaking, is we've seen the yield on the 10-year Treasury note increasing. Yes, it has had a little bit of a blip down recently, but at the same time, the US dollar has been performing quite well, actually very well. And gold has still managed to hang in there. So gold's actually performed flat when two of the bigger drivers against it were really trying to push it down. So that's a positive sign for gold. And so as we get closer to the seasonal period, if we start to see the US dollar pull back and the yield on the 10-year Treasury note correct further, this could really give the gold a boost. So the fact that the negative drivers for the US dollar have not had an impact that they should have had or typically would have had is actually a positive sign that gold could actually perform well in its upcoming seasonal period. If we take a look at silver, I want to talk a little bit about silver. Silver here, you can see here towards the end of the year, it tends to go up, and also into February as well. So this is the time period where silver tends to perform well on average. If we take, and this is from 1984 to 2020, if we take a look at the silver trade, the actual dates I'm looking at here for silver is December the 27th until February the 22nd on a strong seasonal basis. And you can see in this trade, the shaded boxes, look at this over the last couple of decades, it's actually done quite well. And I just want to point out here too, there is a period where silver tends to perform poorly, and that's from mid-April into late June. And I've just put those stats in there as well. If we take a look at what's happening to silver here, here's silver. Silver versus the S&P 500, silver versus gold, and here's the silver, metals and mining versus the S&P 500. Because that's important of what's happening. First of all, silver really has been fairly flat. We're actually back down to really support at this point, or very close to it. We did touch that basis in late September. And we've seen silver underperform the S&P 500. Of course, And silver versus gold, silver's actually been underperforming. And really the big tell on this is if you find the metals and mining sector performing well and the stock market rising, that tends to support, and gold going up, that tends to really support the price of silver. But what we've seen here is we've seen metals and mining underperforming the S&P 500. So it's really pushed silver down here. But once again, we are coming up to the strong seasonal period. So we didn't see that early rally for silver. But as we get to the strong seasonal period starting in late December, this actually could be a good opportunity for silver to actually start to put in a stronger performance, particularly if you see the stock market moving up. And if you see the metals and mining sector actually starting to perform well, that would really give silver a solid boost. So it's important to keep track of what's happening with the metals and mining sector, as well as looking at the price of gold in order to help determine the strength of the silver trade itself. And I want to talk about the NASDAQ trade. So this is I call it do the NAS with Santa. And this is from December the 15th to January 23rd. A lot of people talk about the Santa Claus trade as a few days before Christmas or a few days after Christmas. Really, I think it's much bigger than that. I call it, Santa arrives early and stays late. And the NASDAQ is really where the strong performance historically has been. And so this last column here, if you take a look at these bars here in the last column, represent the outperformance of the NASDAQ compared to the S&P 500 if they're shaded. And you can see here it's been fairly solid, strong performance. I know there's a lot of talk about the NASDAQ being overvalued and also to the S&P 500 as well. But from a seasonal basis, we do see the NASDAQ starting to get traction in the second half of the month, coming what I call the do the NAS with Santa trade. And into the new year as well. And here you can see it, the outperformance relative to the S&P 500 from 1972 to 2020. You can see that tends to be the stronger period for the NASDAQ relative to the S&P 500. So if we do see a pullback take place before that, that could be a good setup, particularly if the Federal Reserve meeting that's scheduled to be the announcements as far as decisions from the Federal Reserve are scheduled to come out on December the 15th. And if the market finds that to be favorable, that could actually help the NASDAQ with its trade overall. This is something to watch out for. And here's the NASDAQ here. You can see here on a absolute basis, it still hasn't really broken its upward trend line here, so it's still in fairly good shape from a technical perspective. And relative to the S&P 500, it's really been consolidating versus the S&P 500 since last year as well. It was overbought in November. It has pulled back a little bit from that time period. But if we see a break above this level, really from February here, towards the end of the month, towards the end of December, that would actually be a positive thing for the NASDAQ trade overall. I want to mention that just as we finish up here and close, that I do have a newsletter, in case you don't know about it. It comes out monthly, and as well I do other videos and reports as well on a weekly basis. This is my November newsletter. I talked about the Federal Reserve being behind the curve. So, and every month I talk about, give a market update. I talk about seasonal trades, how strong they are, what's taking place, anything that investors should be looking at for certain seasonal trades as well. And I try and give an overall seasonal viewpoint on the market. So if you're interested, please go to alphamountain.com. That's alphamountain.com. Just a reminder that is available as a free newsletter that helps complement the whole seasonal trade or the seasonal analysis perspective as far as that goes. And also don't forget my book, the Thackeray's 2022 Investor's Guide, that's just starting to hit the bookstores now. Thank you very much for joining me today.